All right, well, let's welcome our first guest on board, Mark Matthews of Bank Julius Baer, is joining us now to give us his view on all that's transpired so far. Mark, thanks a lot for joining in. There's so much happening, right, across the global markets, but what stands out is the fact that the FOMC minutes are upon us, so that could be the next big trigger. There's the policy in December as well. What is your own expectation of how interest rates could move, and how do you tie in the global equity markets with that?
I don't think the minutes will reveal any softening in the Federal Reserve stance. I think they're intentionally being obscure but leaning toward hawkish in their statements because they don't want to let the market zip back up again, which would provide a lot of stimulus, and they're trying to avoid that at this point in time. And the data is softening just the way they wanted to see it. So I wouldn't expect much from the minutes, but I would say that we've got three very powerful forces contributing to this year-end bull market rally, which I think will remain in place. And some people call these the three horsemen. The first is the interest rates themselves, which, as you know, we're at 5%. Now we're at 4.4 on the 10-year. The second is the dollar, which has gone from 107 down to 103. And then the last one is the oil price, which was at 93, and now we're about 77. And when I put all those together, I see a very positive backdrop for stock markets, but emerging markets in particular.
Okay, all right. Hi, Mark. Good morning, and thanks so much for joining in. Well, what about India? Where does India stand? If you look at the November performance, actually, the global markets have done very, very well. The US markets in particular. And India has participated, but actually we're lagging a little bit behind. Do you think that we'll catch up on the upside? Because earnings growth out here is the best, in terms of policies as well by our government has been fairly good. So your take on India at these levels?
Well, of course, in the emerging market panoply, you've got the biggest ones being Korea and Taiwan. And to my mind, that doesn't make any sense. They are, by all intents and purposes, developed market economies and developed markets. So if we kind of exclude those for a second, and by the way, I do think Korea will be put into MSCI's developed market index and taken out of emerging next year. But let's exclude Taiwan from the conversation as well. Then you've got the really big two we all know are China and India. And China, the economy is still, the momentum is bad. The October numbers show particularly worrying signs in the property sector. Property prices, property sales, new construction starts were all significantly worse than even poor expectations. And so in the absence of a compelling reason to invest in China, you've basically got India because nobody's going to buy Russia. Brazil is something you could look at, but it's for most people it's very far away and hard to understand, and so then you get into very, very small markets like Southeast Asia and the rest of Latin America. So India, yes, no change in our view. We like it. The price-earnings ratio is bang in line with the long-term average at about 19 times forward earnings. And to your point, Nigel, you're looking at high teens, possibly even low 20s earnings growth, depending on what the oil price does. So why not be in India? And we are.
Why not be in India? But unfortunately, we've seen a lot of FPI selling in the Indian equity markets. Now that the US 10-year bond yield levels have come off from the peak levels of over 5%, do you see that reversing? Should we start expecting FI inflows to come back into the Indian equity markets?
Yes, because to my earlier point, the three horsemen I described earlier, rates, dollar, and oil, are best for emerging markets. And the oil price has a much bigger impact on emerging CPI baskets because they have a lot more food and energy in them. The 10-year Treasury yield coming down means much less competition for emerging markets, so the central banks can start to cut rates. And then what was the other one I mentioned? The dollar being weaker. Well, a lot of emerging markets have dollar debt, and so they won't have to pay as much for it going forward.
All right, Mark, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts. So that's the word coming in. By the way,